If we're investing to enrich our lives, but the act of investing is degrading our well-being, then something's wrong. Hello everyone. Recently, Melanie from Perth wrote to us noting that she'd been reading our reports for a long time now, and she'd noticed that none of the Magnificent Seven or similarly strong performing growth and tech stocks seemed to make our portfolio, and she was wondering why. I love the question. And I suppose it'll come as no surprise to anyone who knows us that we subscribe to the philosophy of high conviction value investing. At a very high level, the original value investors would have argued that the only stock worth considering were those that had more value in a fire sale than they had in the share price. Meaning, you could buy a stock today for 50 cents and you could theoretically wind it up tomorrow for $1. Where value investors focused on assets, Philip Fisher and now other growth investors were taking a deep dive into the management and the outlook of their businesses to try and work out what the future held. They recognized that if they could accurately identify companies on the precipice of huge earnings growth, they could profit by buying them today for $1 before the market had caught on to the real opportunity and recognized that the true value might be $2, $3, $4 or more. I think that value investing and growth investing actually come from the same branch of the philosophical family tree. And within fundamental analysis, there's a spectrum, starting on the one end with the philosophy of Ben Graham, the teacher of Warren Buffett and the father of modern day value investing, primarily focusing on the assets of the business. And on the other side, you've got Philip Fisher, father of modern day growth investing, focusing on the earnings outlook for a business. And along that spectrum is every value investor and every growth investor. Because today, just about every value investor will ascribe value to the earnings or the future earnings of the businesses that they've invested in. An excellent example of that is Warren Buffett, the quintessential value investor of our generation, who credits Charlie Munger for his evolving in thinking. And today, as a result, almost all of Berkshire Hathaway's holdings have ascribed value to its underlying operating business rather than just considering its assets. And every growth investor will also agree that there is an upper limit to the price they're prepared to pay for their growth. Let's say I'm shopping for my favorite apples at Coles and I see they're on sale, half price. If I'd usually buy half a dozen apples, and this week I'd probably decide to buy a whole dozen. That's called value investing. But what if I've been reading up on the impact of unseasonal hail in Shepparton, Victoria and its impact on the apple crop? Well then, if I found my favorite apples were trading at a slight premium to their normal prices, I might still choose to buy twice as many as usual because I think that by next week, they're going to be much more expensive again. That's growth investing. Both value investors and growth investors are trying to buy assets at a discount to their assessment of intrinsic value. I think you'll find that historically, both approaches have performed well. And sure, there are some market conditions that'll favor one philosophy over the other. For instance, a low interest rate environment or a falling interest rate environment will certainly favor growth companies. And at other times, when the market exuberance is lower and interest rates are different, value investors can materially outperform. On average, the volatility of a growth portfolio will be higher than the volatility of a value portfolio. And an investor's decision to pursue one philosophy over the other might simply come down to their risk tolerance for volatility and their preferences. For instance, there was a time where a company like Nvidia might have been a value stock, when the company simply made graphics cards for gaming computers. But then, quite by accident, at least from Nvidia's perspective, when Bitcoin miners discovered that you could stack graphics cards to increase the power of their computers, and they later adapted that same process for AI, all of a sudden investors looking for growth would have been attracted to the stock. Ultimately, investing is about two things. Number one, you want to generate a satisfactory return on capital. Absolutely, that's the primary concern. But genuinely good investing is about doing it in a way that you are comfortable with, finding an approach that you can stand behind and it allows you to sleep well at night. Because in the end, if we're investing to enrich our lives, but the act of investing is degrading our well-being, then something's wrong. So for us at Collins Street, that means buying assets at a steep discount to their real value based on today, without excessive forecasting. That's called value investing. For growth investors, though, they might be comfortable with their research. They have to be comfortable with the research. And they have to have enough insight into their companies and the sectors in which they operate so that they can happily and comfortably predict what the future might look like in 3, 5, or 10 years. So, what are my 2 takeaways? Number 1, I think that growth and value are much more alike than many people actually realize. They are 2 branches of the one school of fundamental analysis. And number 2, when it comes to investing, getting a good return is of course important. But as important as it is, doing it in a way that allows you to be comfortable in your position and sleep soundly at night is equally important. Thanks again, Melanie, for a truly excellent question. I hope that helped provide you some clarity on why we have certain stocks in our portfolio. And to everyone else, thank you for sticking around with us to the end. I hope that whatever your preferred approach is to investing, that you find it both profitable and enjoyable. And until next time, bye for now.